Hi, I'm super excited about today's webinar that I want to talk to you about the secret hacks to getting approved for loans and credit cards. And the main reason why I wanted to do this webinar is because I wanted to discuss with you why a lot of you may be getting denied for some type of funding. And there are some steps that you have to make in order to get approved. And so that is one of the main reasons why I wanted to do this webinar, so that I could show you the secret hacks on what you need to do to get approved. Now, what is your end goal as far as wanting to get approved for funding? You may want to start a business, or you want to purchase a home or invest in real estate. Or I have clients who want to start a trucking business, which is extremely very lucrative business to get into. I have some clients who are making at least $9,000 to $20,000 a week, yes, per week, in the trucking business. Same thing with my real estate investment in clients. They are crushing it in that field, especially in the Airbnb or doing fix and flips. Then I have some clients who are wanting to do invest in cryptocurrency or the stock market. And then there's some just want to purchase a home or a vehicle, and they keep getting denied for the loan. And for me, I like to show you what is not being taught to the general public, because there are some things that the credit agencies and the banks, credit unions, they don't want you to know in order to get approved for funding or credit cards. So you want to be able to leverage your credit in order to get approved, so that way it increases your chances of that lender saying yes. And who am I? My name is Erica Harris, and I own a company called PF Source LLC, where I assist small businesses and individuals to help establish your business and your personal credit. And I also provide a mentorship program for startup and existing businesses, and providing them, the strategies that you need and the leverage that you need in order to get at least $50,000 in your business credit. Now, business credit is totally separate from personal credit. Business credit is like personal credit on steroids. And I have such a passion to not only teach small business owners, but I want to be able to build on your business where you're doing something that you're most passionate about. Because a lot of times you can go into a business that you may see other people doing, but if that's not your calling, if that's not your true passion, then you won't be as successful in something that, even if you didn't even get paid to do, you would love and enjoy doing. And of course, you want to get paid doing it. Whether you still want to work your job and do a business on the side, you want to step out and do full-time entrepreneurship. I point you in the right direction, giving you the tools, the resources, the capital, everything that you need to be successful in your business. So that's what I'm passionate about doing. Now, like I mentioned, I have clients that I deal with who are getting denied funding, and they're not sure why. So when I was doing my research, I realized that what is being taught to the general public is not working. They are being taught about this standard pie chart that how a credit score is broken down into a FICO score. Now, I want to also show you that there's a difference between a Vantage score and a FICO score. Vantage scores are what, like Credit Karma, these credit bureaus are using. Credit Karma, that's a credit monitoring service which gives you what they call Vantage scores. Those are not accurate scores. So if your score may say something different with Credit Karma, for example, your FICO scores are what lenders use to get you approved for funding. Now, there's different type of FICO scores: auto loans, mortgage loans, credit cards. They all use different types of FICO scores, so it's important to know the difference. And I help through my program and giving you the model of how a credit score is broken down. But I break it down even further than what is being taught to the general public. Like I said, this is all about teaching you secret hacks to getting you approved for funding. And the standard pie chart is what being taught to the general public is 35% of your credit score is based off of your payment history. As you can see, that's the largest chunk when you're generating your FICO score. And then you got 30% is how much you owe. That's credit utilization. Then you got your length of history, which is 15% of your score. And then you got the credit mix. That's having a combination of installment loans and credit cards. Installment loans are anything that you owe that is a fixed rate, like a mortgage loan, an auto loan, a student loan, a personal loan, that your monthly bill doesn't really fluctuate. And then you have your credit cards, which are revolving credit. Okay, because let's say you have $1,000 credit limit. Once you pay that, you charge up $1,000 and then you pay it down. You have access to that full amount of the credit limit again, over and over and over again. That's why they call it revolving credit. But then you have new credit, that's 10% of your score. Those are those hard inquiries that lenders and creditors put on your credit report when they're checking your credit. Now, there's not a hard pull if you're checking it yourself, or if a creditor or lender is trying to market to you, you know, by you getting credit cards or something like that. They may try to do a soft pull on you to market to you, but when you're actually filling out the application to apply for some type of funding or credit card, or even it could be, you notice insurance companies will pull your credit. There are some landlords that will pull your credit to approve you for getting an apartment. Utility companies, they pull your credit. So that could affect your credit by 10% when that credit inquiry is less than 12 months old. Okay. But to break it down even more, you see these points here? Nobody hardly is talking about the points. The points are what generate that FICO score. Now, how points are broken down, you see that the 35%, the largest chunk is based off of your payment history. That totals up to 192.50 points. Okay. Now, 192.5 points is the maximum amount of points that you can get in this category. Same thing with 165% on credit utilization, 82.5% on the length of history, how long you've had the account opened, then the credit mixture, 55 points, and then you have the new credit, 55 points. But like I said, you can earn up to the certain amount of points in each category. So let's say you only have 35 out of 55 points in new credit because you may have a lot of credit increase. So I'm going to teach you in this webinar how to maximize those points in order to build up your FICO scores even more, to increase your chances of getting approved for the funding. Because I don't want anything holding you back from, if you're trying to start a business or something that you have been dreaming about for years, or you may be struggling in your business and you're not sure what is happening because your scores aren't improving. And you're saying you're paying your bills on time, but you don't understand why your score is not moving, or you may have some negative accounts on there and it's affecting your score and you don't know why. Those are some of the things that I want to talk to you about in this webinar. So, as I was mentioning, the reason why I'm doing this webinar is to help increase your chances. But now here is how a credit score is broken down. 850 is the highest credit score you can get. 300 is the lowest credit score you can get. So when you take those two numbers and you subtract them, that's how you get the 550 points. 550 points is the maximum amount of points that you can earn to help build up that FICO score. That's going to help build up your score to get you approved for funding. So how that 550, the maximum points you can earn is broken down is that you take the 550 and then you multiply it by the percentages that you see in each category. So remember in the previous slide how I showed you all the different points that you can get here? Well, when you break it down by category, remember 35% of your credit score is based off of payment history. So when you multiply the 550 times 0.35, that's how you get the 192.50. Same things with amount owed, 165. Length of history, 15%. That's 82.5. So you're multiplying that 550 times 10%, times 15%, times 30%, times 35% to get the total of the 550. So that's how you can maximize those points in each category. Okay. Now I'm going to talk to you a little bit more. I'm going to show you a chart at the end of the webinar so that you can get a clearer picture of how each category, of how you can maximize those points in each category. Okay. But I just wanted to show you right quick of how it's broken down. So let's start with the largest chunk of how your credit score is generated. 35% is based off of your payment history. That is the largest chunk. So that's 192.5 points. Now, how often are you, that's broken down by how often are you paying your bills on time? That's why it's so important not to have any late payments. One 30-day late payment can drop your score up to 100 points. That's why I'm constantly telling my clients, you do not want to be late on any of your accounts because that can affect not only your score, but it's affecting those points. So you cannot maximize the amount of points that you can get in this category if you have a late payment. And the more times that you're late, the more your score is going to drop. So a 60-day late payment, for example, is worse than having a 30-day late payment. A 90-day late payment is worse than having a 60-day late payment. That's how your scores drop even more. And when it comes to late payments, charge-offs, and collections, those, as you can see, can significantly drop those points further away from you getting the maximum amount of points in that category. And let's say you have an account, a credit report that has no open accounts at all. So then you're going to have to add on additional accounts. You're going to have to apply for, to start off with, secured credit cards or secured loans because you are not maybe going to qualify for an unsecured type credit card. The difference between a secured credit card and an unsecured credit card, the secured credit card, you're responsible for putting the amount of deposit because it's right now the lender doesn't trust you to loan a credit card to you or on some type of funding because you don't have a score yet or you're building up your score. You don't have any accounts reporting. So in order to do that, you want to get a secure credit card where you put down a deposit, let's say $200. Well, that's what your credit limit will be. If you put a deposit of $200, your credit limit will be $200. If you do $500, your credit limit will be $500. But then at the end, once you graduate to an unsecured credit card, that deposit you get back if you don't default on it. But if you don't have any credit reporting, it can take you 4 to 6 months to initially show a score on your credit report. Then you have the next category, your credit usage, your credit utilization. That's 165 points. Now, staying under 30% is good. That helps you get approved for funding. But we're all about maximizing those points. To get 165 points, if you stayed within 2 to 3% of your credit utilization, that is going to help bump up your points even more to help boost your score. Now, I want to show you that there's a difference between a payment date and the reporting date. And I want to give you a tip. This is also not taught to the general public on how to hide your credit utilization. So when you're looking at your credit report, and if you go over 30% of your credit utilization, that is going to drop your score. This is why they're telling the general public, oh, just stay under 30% of your credit limit. Why? It's because they're banking you to go over that, so that can drop your score. But if you stayed within 2 to 3%, that's going to maximize your points, like I mentioned. Now, how you do that is, now you can use up to whatever, this is related to your credit cards, by the way, this particular section, the credit utilization. You can use up to your credit limit each month if you have to. You just need to know the difference between the payment date and the closing date. The closing date is the day they report to the credit agencies. And you determine that by looking at your credit card statement. It's on your monthly statement, whether you get your monthly statement in the mail or you can actually see it online. But it's going to show you the closing date on your monthly statement. Now, if it doesn't say closing date or reporting date, it will say billing cycle. So let's say your billing cycle is between the 2nd and the 27th of the month. The 2nd is your opening date and the 27th is your closing date. That's the day they report to the credit agencies. Now you want to pay your payment down to at least 2 to 3% to maximize your points before the closing date. Why? It's because, remember, that's the day they report to the credit agencies. If you paid it, I would suggest you to pay it 3 days before the closing date. I learned the hard way because when I paid it on the day of the closing date, it didn't show up. You know how it sometimes takes like a few days for them to process that information when you make that payment. That's why I say pay it at least 3 days prior to that. If you're going to stay under 30%, but like I said, 2 to 3% is better, pay it before that closing date. So that way, if you max out that credit card and you pay it down before the closing date to at least under 30%, 2 to 3% is best, that's how you hide it from showing up on your credit report. You see what I'm saying? So you can max out that credit limit as long as you do it between the billing cycle. So once they report to the bureaus, then if they show that you're over 30%, that's going to drop your score. That's why you want to pay it before the closing date, so it never shows up on the credit bureau. Okay, that's how you hide your credit utilization. And when you, like I said, stay within that 2 to 3%, that's how you're going to maximize your points. That's why you need to know the difference between the payment date and the closing date. Now, you still want to make your at least minimum payment by the payment date, so you won't be late. But I'm talking about if you want to pay down your credit utilization even more between that 2 to 3% in order to boost up those points, you want to make sure you pay it at least 3 days prior to the closing date. And like I said, you find that on your monthly statement. Moving right along, the length of history. That's 15% of your score, 82.5 points. Now, the length of history is different than your payment history. The payment history is how often are you making your payments on time? Do you have any late payments, collections, charge-offs, and things like that? The length of history, which is 15% of your score, is how long have you had your accounts open? So the longer the history, the more points that you receive. So, for example, a credit card that is only a year old doesn't weigh as much weight as a credit card that, let's say, is 9 years old. So the longer the history that you have on that account, the more your scores will increase. Now, lenders are looking at the average age of your account. That's how a score is also being generated. What they're doing, for example, let's say you have 5 credit cards reporting on your credit, on the credit bureau, on your credit report. So If you have a credit card, let's say that is 5 years old, then you have one that's 4 years old, one that's 3 years old, 2 years old, and 1 year old. What they're going to do is take the 5 credit cards that you have, the length of history that you've had those accounts opened, and then they're going to total up those total cards that you have, and they're going to divide it by the amount of how long you've had them open. So that's how it's going to be. That's how they calculate the average. So that, like I said, they total up all the cards that you have, the 5 cards, and they're going to divide that by the amount of the length of history that you've had them open. So you may have credit cards that are 5 years old, but if you start opening up a whole bunch of new credit cards, that's going to lower your length of history. That's why I tell clients, when you have, let's say, a card that's been open more than 5 years, and then you start applying for, let's say, 4 or 5 new credit cards, that's going to lower your length of history. So that's going to affect your credit score. So to get the maximum amount of points, the longer you have that credit card open, the more points that you're going to get. Same thing with your mortgage loans and all of that. That's why I tell clients, you don't want to just not only be applying for a bunch of new credit cards all at once, because you want to let those credit cards season to at least 2 years so it can gain that history. And another thing, you don't want to just close out open credit cards, because I have clients who tell me, oh, I can't wait to pay off my credit card so I can just close them out. But my question to them is, when you close out your credit card, now you're losing the length of history because it's no longer reporting. So even if you may have a credit card that you pay to a zero balance, keep it open, because you're running the risk. If it's been open, let's say if it's been open 5 or more years, that's going to hurt your score. So don't just go closing out credit cards just because you pay them off, because that can hurt your score. Now, if you have a subprime type card, like there's these cheesy credit cards like First Premier, Credit One Bank, those are those subprime cards. Even if you have a long history on those and you start getting better type credit cards like an American Express or a Chase card or something like that, at least if you keep them open, just keep them open and use those subprime cards just once or twice a year just to keep it active, because you don't want to lose that history on your account. But if you have a lot more, let's say you have like 17 credit cards, now you have better type credit cards, then you may be able to afford to, but you have to look at the length of history that you have on those accounts. Because if you had it less than 2 years, then it probably wouldn't make a difference if you had a bunch of other credit cards reporting. But you just don't want to close out credit cards just because you pay them off, because you may run the risk of losing that history, and there you can risk those points. Remember, the maximum amount of points that you can get in this category is 82.5. So it can lower those points if you close out those credit cards, okay? Another thing that's important, you don't want to delete all the accounts on your credit report if you have something negative. That's why I don't believe in credit suites. And when you do credit suites, it just removes all the negative accounts. But what if you have history? Like, let's say you have a mortgage loan or a student loan on that credit report, and you've had more on-time payments than late payments. You don't want to just delete the whole entire account, because that could lose your length of history. Let's say you've had that account open like 5+ years. That you're going to lose that history. So you really, when you're doing credit repair on your credit report, you want to really dissect those accounts to see which ones that are going to benefit you in those points to keep them open versus just deleting them, because that could risk you dropping your score. Now, bank credit cards weigh more, have more weight than regular type credit cards. The reason why is because lenders like to see what is your highest credit limit that you have on a bank card. And a lot of times, if they're determining what type of credit limit to give you, they're going to look at that bank credit card. They're not really looking at more so the store cards, even though that may help build up your score, but they're really going by bank cards because when you have a relationship with a bank, that speaks more volume than if you have a relationship with just Macy's, like just a store credit card like Macy's or Lowe's or Home Depot. So what they're doing, the lenders are doing, are they're going to look at your largest credit limit that you have from a bank, and they may either match, when they're determining what kind of credit limit to give you, they're either going to match it when you're applying for new credit, or they're going to double it. And that's going to help you when you're trying to increase your credit limit as well on the card that you already have. Or if you're trying to apply for new credit, that's going to help you get a larger credit limit, because they're going off of bank credit cards, your limits on your bank credit cards, more so than your store credit cards. That's why I wanted to say that your bank credit cards that you have, like through Chase, other banks like Capital One, they speak more volume than just having a store credit card. Then you have your credit cards that you, another thing that I want to show you is that when you have a credit card that is an authorized user, from an authorized user. An authorized user means that you're piggybacking off of somebody else's credit. So let's say you're trying to build up your credit and you don't have enough open accounts. A way to help boost your credit score up to at least within 30 days is to ask a friend or a relative if they have a credit card, at least one credit card, that they've been making on-time payments, staying under 30% of whatever their credit utilization is. The longer the history that they have on that account, the more your scores will go up, okay? So if you ask that person to add you as an authorized user to that credit card, their credit card, that will help boost your score up within 30 days. But you want to pick someone who you know have made on-time payments every month with that credit card and have been staying under 30% of your credit utilization. Because if they're maxing out their card, or if they've had some late payments, that's not going to help you. That's not going to help you one bit. So you want to make sure that they're staying under that 30% and making on-time payments. Now, let them know that it's not like being a co-signer. They're not going to inherit anything from your credit report or anything like that. They're simply adding your name to that credit card to help boost your score. My sister-in-law did that for me, and it helped boost my score up 80 points. She added me to 4 of her credit cards. Now, here's a caveat. You want to make sure that you can add more than one. However, it's important that you're adding primary accounts. There's a difference between primary accounts and authorized user accounts. Primary accounts are the accounts that you open when you're applying for credit cards and loans and things like that in your name. If you're an authorized user, that credit card doesn't belong to you. It belongs to whoever that person who added you on as an authorized user. So a lender will see that on your credit report. So it speaks more weight for you to have your own accounts on your credit report. Now you can have 1 or 2 authorized users, but you want to have the majority as a primary account. That's you as the individual applying for that credit card, okay? Then credit mixture, that's 10% of your score. Now, that's 55 points. To maximize your points in this category, let's say you had a mortgage loan, an auto loan, some type of personal loan, and let's say a couple of credit cards that are all reporting on your credit report at once. That can help you maximize your points in this category. But if you only have, let's say, a couple of credit cards, but you have no installment loans, which are mortgage loans, auto loans, or personal loans, you're not going to maximize your points in that category. And like I mentioned earlier, bank and credit unions, those type of credit cards and loans are more beneficial than store cards. So when you're applying for, let's say, a secured loan, which a secured loan, you're giving a deposit, you're paying a monthly fee every month, but then at the end you get your money back. Or you're applying for a personal loan through like a third-party company versus a bank, you won't be able to maximize your points like you would with a bank. Because remember, banks and credit unions are more credible to a lender when they're determining whether or not to approve you for funding than going through a third party source. Okay, so secured loans and secured credit cards can help boost your score even if you don't have that much credit. So that's why I mentioned before, you still, let's say if you wanted to apply for a credit card but you got denied because your credit isn't strong enough, you can apply for a secured loan or a secured credit card. All right, the next thing, hard inquiries. I say hard inquiries because there's a difference between hard inquiries and soft inquiries. Now, hard inquiries affect your score by 10% if those hard inquiries have been on your credit report for less than 12 months. If the inquiry is more than 12 months, it's not really affecting your score, even though it's reporting on the credit report. If it's over 2 years old, it should fall off. So the difference between the soft and the hard pull is the hard pull, like I mentioned before, if you're applying for some type of funding or credit cards, or someone is pulling your credit for you to apply for something, that's going to be a hard pull. But if you're pulling your own credit, for example, or someone's trying to market to you, you know, when you get a bunch of junk mail, they're pulling your credit, but it's a soft pull. So, but a hard credit inquiry will affect your score by 10%. And how? That's 55 points in that category. Okay, so the more you start applying for all these credit cards or loans and things like that, that's going to drop your score. You can have, that's why I tell clients, you can have a 750 credit score, for example. But if you have a bunch of inquiries on your credit report that are, let's say, within 6 months, you can still get denied that funding. Same thing with credit utilization. You can have a 750 credit score, but if you're over that 30% of your credit usage, that can still get you denied some type of funding because you're not maximizing your points in that category. Okay, so you want to also know which creditors and lenders pull from which credit agencies. That way, when you're applying for funding, you may have a lender that only pulls Experian. You may have another lender that pulls from Equifax or TransUnion. So you can apply for more credit with less inquiries if you know which creditor or lender pulls from which credit bureau. And that's something that I teach throughout my mentorship program. Now, this is a graph that I wanted to show you that goes more in depth of how to maximize your points in those categories. So the first one, remember the payment history, that was 35% of your credit score. The maximum amount of points that you can get, of how to build up those points, this is related to the number of months since the most recent inquiry. So let's say you don't have any negative accounts showing up on your credit report. No late payments, no collections, no public records like bankruptcies, none of that, no charge-offs. That's how you can maximize your points, by 75%. Okay, then 0 to 5 months. So let's say you do have a late payment that showed up on your credit report that was within 5 months or less. Then see how you have 10, you only get 10 points in that category. Then 6 to 11 months, you only get 15 points. 12 to 23 months, that's 2 years. So if you have, let's say, late payments or a charge off or a collection within 2 years, you're getting 25 points. But see how your points are starting to get higher and higher the more the longer it is that you've had that delinquency reporting on your credit report. So let's say it's been more than 4 years, then you can get 55 points. But like I tell my clients, when you don't have any negative accounts, you see how you can maximize your points regarding this category in payment history? That's why you run the risk of getting denied funding because you're not maximizing your points in this category, and you can risk getting denied. So the longer your history on that account, yes, you may have 55 points, but that's not maximizing your points. That's not building up your FICO score as much as not having any type of negative accounts reporting. Then the next category, remember I talked about credit utilization, that's 30% of your credit score. Okay, that's 165 points. So let's say you don't have any credit cards reporting on your credit report at all. You get 30 points for that. Now, let's say you have a credit limit. You have a bunch of credit cards, but they all have a 0%. You get 55 points in that category, because I have some clients, they have, like, let's say 3, 4, 5, 6 credit cards, but they all have a 0 balance on them. They get 55 points. But look here, this is something extremely important that I want to show you. If you have a small balance, remember when I talked about staying within like around 2 to 3% of your credit limit? Look at the difference, 65 points. So if you have, let's say, 5 credit cards and they all have a 0 balance, you get 55 points. But if you have the same 5 credit cards, and let's say 1 or 2 credit cards had a small balance between 2 to 3% of their credit limit, you can get the maximum amount of points in that category. That's why I tell clients, stay between 2 to 3% of at least 2 of your credit cards. Okay? That's if you have a lot of them. Because if you stayed at 0% every single month, another thing that you risk is if you're not using that card, you run the risk of that creditor either closing it out or lowering your limit. That's happened to me twice because I wasn't using my credit card. So you want to make sure, the reason why they do it, because you're not making them any money. They're like, well, why should I extend credit to this person if they're not even making me money? So I'm going to close it out or just lower their limit. And that can happen overnight, and they don't even have to tell you that. Okay? That's in the small print that you sign when you fill out the application, by the way. So they have the right to do it. So staying within, I would say 2 to 3%, but under 6%, that's how you can maximize your score. Now, you see how your scores go down when you start using your card, your balance gets higher and higher. So if your credit balance is between the 7 to 19%, you only get 50 points. If your utilization is between 20 to 49%, you only get 45 points. 50 to 89, 25, 90% or more. If you're maxing out that card, you're only getting 15%. That's why staying within that 2 to 3%, under 6%, is best to maximize your credit score. Then you have, I wanted to spend more time on those two because these two affect, when you're breaking down the payment history, remember that's 35% of your score, and credit utilization is 30%. That is the biggest chunk of your score. That's why I wanted to spend the most time on those two. Then you got your length of history. How long have you had these accounts open? So the number of months that you've had open, the more your points that you'll receive in that category. So if you've had that account open less than 12 months, you only get 12 points. That's why I'm telling clients, you don't want to just keep applying for more and more credit, because if you do, it's going to lower your credit points, which lowers your score. 12 to 23 months, so a little under 2 years, you get 35 points. But look at how your score increases in the number of points you get for having a credit card or a loan open longer than 2 years. Now you're getting 60 points. 48 months or more, so more than 4 years, that's 75 points. So that's why you want your credit cards to season, or you don't want to be closing out credit cards because you're not maximizing your points in that area if you do. Okay? Or just deleting all types of accounts. And if you got a length of history on that, let's say mortgage loan or an auto loan or something like that, you don't want to just be deleting everything if you've got a good history, a good payment history, and a good length of history on that account. And then the next category is your credit mix. All right, so do you have a mixture of credit cards and loans? And remember, bank credit cards speak more volume to a lender than store cards. Now, if you don't have any type of credit mix, let's say you don't have anything reporting, that's only 15 points. Remember, you need to build up your credit by applying for credit lines like credit cards and loans to start building up your score. If you only have one account, that's only 25 points. But look down here, 3 points. If you have 3, that's 60 points, and 4 more, 50. So you want to have a credit mixture, but you don't want to have too much credit on there, especially if it's reporting negative, in order to maximize your points. And then lastly, you got hard inquiries. The number of inquiries that you have is specifically less than 6 months old is going to speak more volume than if it's over 12 months old. Because like I said, if the inquiry is over 12 months old, it's not affecting your score, even though it may show up on your credit report. But if you don't have any inquiries showing up, that's 70 points. See how you can maximize your points in that category? If you have one inquiry, that's 60. But look at here, if you got 4 or more, you're only getting 20 points. So that's why you don't want to just keep applying and applying and applying for credit, because you're running the risk of you getting denied because you don't have as many points in that category. Remember, the goal is to help maximize your credit score so that it can increase your chances of getting approved for funding. This is how a good credit report should look, okay? 100% of the payment history, so meaning that you want to make sure you're making your payments on time. So all of your credit cards, your loans, you don't want to, remember, one 30-day late payment can drop your score up to 100 points. And it's going to be harder for you to catch up when you have those late payments. Your credit card utilization, you want to stay between 2 to 3%, but staying under 6% is good, but 2 to 3% is best to maximize your score. Because remember, if you stayed at just 0%, remember, you're not maximizing your score. Derogatory marks, you don't want to have any. No collections, that means collections and charge-offs and things like that. Age of credit history. Remember, the longer that you've had that account open, the more it's going to increase your score. So if you've had that account open for 5 or more years, 5+ years, you can help maximize that score. The number of total accounts. You want to have at least a total accounts of 10. This particular person had 17, but at least 10 accounts would suffice. But of course, with no late payments or anything like that. So the total accounts is a mixture of the, remember I mentioned, if you have a mortgage loan, an auto loan, a personal loan, and at least a couple of credit cards, that's helping you maximize your score in the total of accounts. Hard inquiries. This is a good one. 2. If let's say you only had 2 inquiries on a certain credit bureau, that's going to help maximize your score. Now, if you have less than 4 or less, you can still increase your chances of getting approved for that loan or that credit card. You just don't want to go over 4. Now, remember, in my mentorship program, I teach you how to apply for more credit with less inquiries, because I know which credit bureaus that they pull from. All right, a recap. So what I talked about was the accurate way of how to read a credit score by breaking it down into points, so that way you can leverage those points to build up that score, and talk about how you can maximize your points in each category to help build up that score to increase your chances of getting approved for that loan, that business loan, that auto loan, or if you're investing in real estate, you may need to invest in real estate. And they're looking at your scores, because I work with lenders on a daily basis, so I know what they look for in order to accept or deny your application. So I thank you for attending this webinar, and I have my contact information on here. with my phone number and email address and website. So if you need to get in touch with me, feel free if you have any additional questions. But hopefully this has been very beneficial for you and to increase your chances of getting you approved for funding, because they don't really talk about points to get you approved for funding. Because you may be wondering, like I said, why are you getting denied for funding? Or what can I do to help increase my score? Those are the things that you can do in each category to help boost up your score, to help so that you can have the financial freedom that you want. Because you and I both know credit affects practically every area of your life, not just in lending, in loans and credit cards, but you're paying a higher interest in utility bills, your insurance premiums, you name it. And some people get denied for jobs because they don't have good credit. So, or a phone. Then you may have to pay a higher deposit to get a phone, or some even landlords are denying you for an apartment because of your credit. So I'm teaching you how to maximize your points so that you can get the loan or whatever it is that you need and work towards financial freedom, because it's like having a large weight put on your shoulders when you don't have good credit. So I want you to have leverage over these credit agencies, because they're in the business to hurt you. The lower your credit score is, the more money they make. So this is why I wanted to help you have leverage over the credit agencies versus the other way around. So thank you for attending the webinar. And if you need to get in touch with me, here's my information. Now, I want to talk to you about if you're in, let's say you want to start a business or you already have a business. I mentioned a little bit before, business credit is like personal credit on steroids. And I teach my clients on how to obtain at least $50,000 in business credit cards that only report to the Business Credit Bureau. So that protects your personal credit. You have business credit cards that only report to the Business Credit Bureaus, where it doesn't even report to the personal credit bureaus. Now, how that benefits you is that your business, so they are more apt to give you higher credit limits. Then it's only reporting to the the business credit bureaus, so it's not even reporting on the personal side. So think about how much leverage you can have when you have business credit cards versus personal. I hardly use my personal credit cards anymore as an entrepreneur. The reason why is because, for example, you can go over 30% of your credit limit on the business credit cards, and you can do that as long as you make your payments on time. Why? It's because utilization doesn't matter. Because your payments are not reporting on the personal side, it's only reporting on the business side. So you see how you can go over you can maximize your credit limit. They don't care as long as you make your payments on time, because you're a business, it's not reporting on the personal side. So let's say you want to start that, you want to invest in real estate, or you want to start a business in the trucking business, or you want to start a car rental business, or let's say you want to buy a food truck. People who purchase food trucks, they're making really good money. Or whatever, online e-commerce business, that's really booming. To do some type of online business, or a lot of people are investing in cryptocurrency, or whatever your passion is. In the Business Credit Mentorship Program, it's a 6-month mentorship program, okay? And these are the things that I show you some of the things that I show you that comes with the 6-month mentorship program. I teach you how to set up your business profile correctly so that it increases your chances of getting business credit funding, okay? Because you can get denied if you don't have a business address, business email, things like that. Your business has to be compliant. And I teach you how to build up your business profile correctly, because if you don't have your business profile set up correctly, now you can get denied. And that's something that the banks and lenders are not telling you, okay? So I help you to build, because before you even apply for funding, this is what you want to have in order before applying. And then I help you to apply for business lines of credit with less inquiries. I teach you how to know the difference between which credit bureaus pull from which credit agency to maximize your funding potential. I help you build up your credit. There's some credit cards that you can, and you can get auto loans just using your EIN number, where you don't even have to put your social security number on the application. So there's credit cards that I have that I only use my EIN number. I'm teaching you the things that I did to help build up over $200,000 of credit that I have, business credit that only reports to the business credit bureaus. And like I said, I teach you how to remove inquiries off of your personal credit. When you're applying for business credit and you have a bunch of inquiries on your credit, your personal credit report, because they're going to pull your personal credit to get you approved. But once you make your payments, it only reports to the business credit bureaus. But I teach you how to remove those inquiries off your personal credit. Because remember, when you're making your payments, it's only going to the business credit bureaus. So you can get those inquiries off your credit report. Then I teach you which credit unions and banks to build a relationship with that you can start applying for funding. I love credit unions specifically. And I know the type of credit unions that you can apply for that don't charge you a lot of fees that a lot of these big banks do. I teach you how to apply for multiple credit cards all in the same day to increase your chances of funding and getting those and getting less inquiries. So I teach you how to get approved for the right type of credit, lines of credit that only have a 0% annual percentage rate. So that's like someone giving you a free loan. Let's say you get a 0% annual percentage rate on a certain business credit card for up to 12 months at least. That's like someone giving you a free loan where you have up to 12 months now to pay it back. But let's say you weren't able to pay off that full balance. I teach you how to do balance transfers and which credit unions and banks would do balance transfers without charging some of them don't even charge you balance transfer fees. So I teach you that in the business credit mentorship program. And I teach you how to maximize the amount of reward points. I'm able to fly a lot of times for a deep discount or for free, or stay at hotels at deep discounts or for free. And on groceries, save money on groceries and restaurants and all of that. Which credit cards give you the maximum amount of reward points so that you can, I'm all about saving money in your business. And I teach you how to do that in this business credit mentorship program. Now that is $997. Now, if you sign up with Credit Repair, you receive a $200 discount. So any existing clients that I have receive a $200 discount. So it's only $797, okay, for the business credit building mentorship program. So I'm super excited about all the things that I shared with you. And hopefully you'll take advantage and take action now, because you don't want to keep suffering and wondering what's going on, why I keep getting denied for funding. But and with this business credit builder program, a lot of things that you don't have to worry about your personal credit on is what I teach you. So I thank you again for attending. And this is my contact information. My name again is Erica Harris from PF Source. And this is my contact information, 314-451-1055. And you can reach me at customer support at pfsource.com or on my website at pfsource.com. Thank you, and I'll talk to you.